All right. Here we are with another episode of the Wealth Building Strategies Podcast. I'm your host, Jeremy Constantino. And today I'm pleased to have on as a guest Mark Adair Rios. Welcome, Mark.
How you doing, Jeremy? What's going
Doing
on?
good. It's a nice Friday.
Yeah, totally. Thanks for
So,
having me.
yeah, it's an honor. So to introduce you, Mark, you have over 20 years of real estate experience. You're the founding partner of Prosperity CRE with over 900 multifamily units and 75,000 square foot of commercial properties under management. Also, Mark created Trisource Capital LLC. Has ranged over $43 million in debt, structured capital, and credit facilities for third party clients. And which is very interesting to me, and would love to get into this, over 30 years in the entertainment industry.
Right.
And so I have on here, you've appeared in over 175 television, film, and commercial projects.
Yeah, that's right.
So
That's right.
welcome, Mark.
Thanks, man. Yeah, I interesting thing. Yeah, you know, the entertainment business is awesome. I grew up here in LA, and so it's almost like you kind of fall into it if you have a certain kind of personality or you hang out with a certain group of friends and stuff like that. So it was very easy for me to get into the business. And luckily, I had hair for a long time and had a good smile and somehow kind of made my way through and made some money and did well. But real estate was always kind of there as a way to keep me out of the bars and the restaurants as a waiter. So, and it's funny because out here you can throw a rock and you'll hit some actor that's a realtor. So that I think everybody has the same idea as me.
So yeah, let's just jump in. I guess I'd love to spend this time in this podcast talking about your story, going from the entertainment business and into real estate and your passion. So I guess we'll start out with what were you involved in as far as an actor?
Yeah, so I'm a film and TV actor, but I actually early on when I was younger, um, I kind of fell into the business. My friends were all kind of, I guess you'd call them teen actors, teen movie stars, stuff like that. I was kind of wasn't in the business, but I was kind of related to it from my friends, kind of hanging out, and got very lucky. Kind of coming of age and wanted to. I was working at a supermarket and wanted to kind of do something, right? And luckily, a friend of mine introduced me to his agent, who happened to be like one of the biggest kind of teen young person agents in Hollywood. And I looked young, right? I was 18 years old and I looked like I was 16, 15, 16. And so, that's something that really has a lot of value in the business, because you can work 12 hours a day and not have to take breaks or go to school, things like that, right? You're 18 years old. So that worked, and then I ended up doing a play a couple years after I started. I was doing commercials, doing some TV and stuff like that, but I did a play and really fell in love with the acting part of it. And for me, there's three kind of ways in the entertainment industry, in terms of I guess things to love. At least for me, you have the business side of things. Maybe there's four. You get the business side of things. You have the Hollywood side. You have the actual working on set side, and then you have the acting part of it, the artistry. And the two loves of my lives really are the artistry and the actual working on set with people that are of my ilk, right? These are working class people. These are crafts people, trades people, people who are really really good at their jobs, and they're just going to work every day and making movies or making TV and stuff like that. Love, they're like carnies, right? Once you're in the carnival, it just never leaves your blood. So I never really got on with the Hollywood part, and the business was kind of a necessary evil. Anyway, you you know you can work out here, but even when you're working, the income is very sporadic,
Hmm.
right? Even when you're on a TV series, you can make 200 grand a year and make it in 4 months or 6 months, and then you might not work for the rest of the year while you're waiting for the show to come back and you start
Right.
filming again,
Right.
right? Or in my instance, I'm a character actor, so I would work, throughout the year, but there'd be times when it's just, you blow through a couple grand very easily, and so it's very high pay but very sporadic
Right.
income.
Most of our listeners are realtors because I'm a broker owner and we have a lot of
Right.
realtors that listen to this podcast, and it's the same thing in our industry too. You could have a month where you do 3 or 4 sales, but then go 3 or 4 months with no sales.
100%. And you wouldn't think that, going from uh from acting and then trying to add another entrepreneurial kind of endeavor like becoming a realtor, is smart. But those times that you're down, or even the times that you have some time off, being able to do something that allows you the flexibility to be anywhere you need to be, but still be professional. It's a perfect job if you can make it work and if you have a facility towards real estate. So I actually got into the investment part. I was really interested in creative real estate. This is probably 1998, 97, 98, something like that. And really, I like the Ron LeGrand type of stuff. So we would do subject twos, wholesaling. I was learning about seller financing, wraparound mortgages, all that stuff, and really kind of got in on that. But I quickly learned that in order to keep my deal flow going, I really wanted and needed access to the MLS. And that was really, my kind of entry into getting my license. It wasn't because I really wanted to help residential people, find their houses, although I wish I had that thing about me. But I hated being a realtor, that aspect of being a realtor, to be honest. Um,
Yeah,
and so, but
that's
go
the
ahead.
same that's the same as my story as well. I was doing investment projects, residential investment projects, and I realized I really needed that access to MLS, and that was my
Totally.
primary reason for getting my real estate license.
Yeah, because you can only work a buyer's agent, or gather up like five buyer's agents in order for them to send you, like download a list of,
Right.
but
Exactly.
like you can only promise them so much
Right.
before they're going to start asking you, hey man, you know, can I have that listing, or let me find a
Well,
house for you.
it's all about knowing the ARV too, or the after the repair value,
100%. Yeah,
because you got
you
to
need
have
comps.
access to the sales comps.
Yep.
That's everything in our business.
Comps is everything. Yeah. And this is, for me, that was it wasn't pre-internet, but it definitely was pre-Zillow and all of this,
Yeah.
automated stuff. So comps, the information was really closed in. Now it's kind of opened up a little bit, and it's you
But
know
it's still difficult getting realtors to work with
oh yeah,
investors. So that's why it's a rare find to find a realtor that works well with investors on the residential side.
yeah. And you gotta prove it, right? If you're a real cash buyer and they see you do one or two transactions, they'll be all over you. You know what I mean? And that's what I mean by you can only work them so far, like because you're kind of faking it until
Right.
you get some deals, and then they don't want to hear anything about creative structure. They don't want to know that you're doing a subject to. Like, how are they going to get paid? I mean, it's so anyway. I did that for a few years. I actually went into the mortgage lending business. All of this stuff, it turns out that not only did I have a passion for the transaction and a lot of the other elements that went on surrounding real estate, but you know, I it came easy to me in a lot of ways. I don't know why. I just kind of understand it. You know,
Did you ever represent clients as a
I did.
realtor?
I did. Yeah. Yeah. I had some listings. I had some buyers. I was doing transactions. I actually was at a mixed brokerage. So we did a lot of loans as well. So I was able to, this is pre NMLS. So we were able to, you know, under the guidance of our broker, write loans and
Right.
help clients that way. But unfortunately, we were also right on that ramp up. This was 2005, six, seven, eight on that, I hate to say it, but I probably was contributing to, some of the craziness that was going on, in the markets. Then the crash happened, and barely, kind of, uh, you know, hung on and really kind of leaned back into the acting part of things when the crash kind of happened, but still it was rough, because I was an entrepreneur, right? On both
Right.
both businesses. And once things kind of stabilized, I wanted to get back into investing, and kind of got back into the residential side of things, but I decided I did not want to be really an active realtor. And then somehow, I did a couple of seller finance deals. I did some wholesale. I flipped some houses out here in LA, wholesale, did a lot of wholesaling. I was making pretty decent money because houses were cheap. And then, I don't know. I think I needed to raise capital to do some of my seller finance deals. And that's how I started to kind of inch my way. I had a conversation with a prospective investor on the phone, and he started talking to me about, well, are you institutional capital? Are you, what's your cap rate? I didn't understand a word of it, but it totally intrigued me. Like, it totally got me. I was like, I didn't ask him, but I was like, what the hell is this he talking about? And somehow, you know, I don't know what it was, but the universe conspired to kind of point me in the direction of more commercial stuff. And I ended up finding a great mentor. He was, he was a ex Wall Streeter who was doing commercial real estate finance, and started kind of learning all of that stuff. And then once I went commercial, I never went back. That was really it. And that's when I kind of started off with Trisource Capital, and went from
Yeah,
there.
yeah. It's interesting you say mentor. It's not interesting. It's just every person that we interview, they all have a mentor
Yeah.
that are succeeding in commercial real estate. They have somebody that gets them to understand the game and
Yeah.
how to 10x their business.
Yeah, totally. You can't, I mean, number one, there's two things, right? We're entrepreneurs, and just about everything that's out there has been done. And so it's in successfully, right? And there's a lot of failures, but there's a lot of success out there that you can model, that you can follow in the footsteps on.
Right.
And then the access to information is so incredible that even the biggest of mentors are out there putting stuff out there for you to be able to, if you really, follow it and you align with it, you can make something happen. I really believe that, not everything is wasted. Even if you're paying 20, $1,000 for something, it's really about the value that you get, and how you apply yourself, and what you make of that. Not everybody's getting ripped off in every situation.
Yeah, I recently bought into a mastermind, and I think that's how we connected. So
Mm-hmm.
that mastermind, it's 15, $20,000, but what I've been telling people, in just 2 weeks, I've already had an infinite ROI in just the simple concepts that you hear before, but until you see the mentors or the other peers that are in the mastermind, they're showing you how to do it, and then it just clicks. You're like, that's what they're talking about. But
Yeah.
it takes being a part of a network to really understand these different principles.
Yeah, that's really weird. It's interesting you say that, because, like, growing up the way I did, my my college education, I dropped out of college to become a full-time actor. And but when I went into the theater, I was studying 4 days a week, probably 12 hours a day. And it was a working theater. So I was, actually acting all of that time. It was almost like a conservatory. And I did that for almost 20 years. I did that for a very, very long time. And the education, it was an art center, but the education that I got out of that, I compare it to really kind of getting my master's in that. But I didn't have a formal education. I only went back to school just recently to complete my degree. Now I'm on to my master's right now in real estate. And but I think I lost my train of thought there a little bit. But um I think the the when you go to a school and you get your degree, a big part of that is the networking that you get out of it.
Right.
But it's
Right.
it's worth, especially when you go to an MBA, some of the master's programs, things like that. The Being able to network with your peers who are going out and working
Right.
professionally is really huge. And that's a big part of, the $100,000 you might pay
Right.
and it's kind of the same thing. Like, our mastermind, we're learning a lot, but it's turning out that the network Like there's so many resources that you probably aren't finding out there,
Right.
you know.
Right.
It's concentrated and you literally can kind of put something out there and get a response, and it could be a game changer for me, whether it's
Right.
a deal. This is our particular one, but it could be a deal. It could be some tool or productivity thing, or some
Right.
marketing automation thing, or whatever it is,
Exactly.
you know and doing it on Facebook, you don't always get the proper answers,
Right.
because
Right.
people aren't leveled up in a lot of ways.
Yeah. I started investing in 2005, and even in 2005, there was not that many. I don't know when Facebook started, but the Facebook network groups weren't really in place there, and so it over the next couple of years, then all of a sudden the internet just started opening all these doors, so you could learn from all these different people and all these different resources. And then now fast forward to 2022, there's an infinite amount of wealth out there, from information regarding investing, regarding syndication, regarding commercial real estate, that is now leveling out the playing field for smaller investment companies like ourselves, that we can grow our business.
Yeah, I liken that to what we're seeing is the language in the how to of syndication and commercial multifamily. It's becoming democratized. It's also becoming commoditized in some ways, which sucks, but it's becoming democratized. So I liken it to when we were kind of doing stuff back in the early, aughts, that we were doing wholesaling and stuff like that, and it was huge, and it's still kind of big. But like, in 2002 through 2006, wholesaling and flipping housing, it was really, really big. But
Yep,
you
exactly.
you were learning from tapes, you were learning from CDs, you were going to these boot camps, but you were actually learning in the boot camp, and it was less about the networking and stuff like
Right.
that.
Right.
But a lot of people were there. It was something that people could get into and do. And now the syndication part, people are learning about that because of the gurus that are out there that are teaching it. And more and more people are getting into the space, whether it's
Right.
buying their first 8 unit or buying their second 20 unit or 50 unit or whatever it is,
Right.
you know,
Right.
for
So
better or for worse.
so go back to your story. Did you do Trisource Capital first or
Yeah.
Prosperity CRE first?
No, I I didn't really get in on the ownership. I was really trying to, I was still in the business and really trying to create an income in a field that I liked, right? And I just love the business aspect of it. I didn't really get that we were doing multi-million dollar, dealing with multi-million dollar businesses, right? But just being able to be fee based, work for 3 months and get one deal and cover my nut for a year and a half was so much better than earning 5 grand a pop or 10,000 a pop, either wholesaling or
Right. Right.
flipping
Right.
or being a
Right.
realtor or a
Right.
loan originator. Just and so started Trisource Capital, started learning about the entire capital stack, really started kind of digging deep into my finance side of things. Again, found I have a little. I suck at math, but I do kind of understand some of the finance stuff, and I like it. It's very interesting to me.
So
And
explain what Trisource Capital, what services you
so
guys provide.
Trisource Capital was basically a capital intermediary, so a mortgage brokerage for
Okay,
commercial real estate.
got
But
it.
we also help place and consulted on higher up in the capital stack. So mezzanine, preferred equity, we would help place. We would help clients with JV equity, and I play in the 5 to say $50 million space, so
Okay.
lower middle market,
Okay.
but with some established kind of sponsors who had a little bit of a track record.
Yeah. So talk about
Um,
the sponsors that you worked with. What kind of owners were they? Were they just like companies like us, or
yeah,
institutional, or mom and pops? I guess. How would you describe?
yeah. So I learned kind of early on to try not to waste too much time on absolute, you know, beginning startup kind of companies, right?
Okay.
And so I wanted it, for me, I wanted companies that had a few deals, but weren't so far along that they didn't need a little guy like me. They would go to another,
Got it.
a bigger house that had more relationships than I did. So I had to carve out a little niche um, for really this kind of lower middle market space. You're buying a $5 million um, multifamily property. You're probably getting into the 50 unit property, 50 to 75 units, something like that,
Okay.
maybe 100. And and I'll help you place your loan and maybe try to find you a little preferred equity if you need it,
Got
things
it.
like that. And then I got really lucky because I hooked up with an RIA, and we started going out and really placing preferred equity as a bridging type of money for larger syndicators who were doing Delaware statutory trusts. And what that
So
means
can you
basically,
explain that to?
yeah. So Delaware statutory trust is I guess it's a kind of a syndication scheme, but the way that the paperwork is set up, it's in a trust structure, and the sponsors, they're really kind of tied into a management position where they can't. It's not really a value add type of play. It's a very kind of cookie cutter coupon clipper type of thing, but it's probably an entry for people who normally would invest in REITs, but they don't really want to get too kind of value add and risky on the private equity real estate stuff that we do,
Got
right?
it.
So it's kind of sits right in between there. They're generally newer properties. You're not necessarily going to have a lot of a lot of renovations and risk on the construction side, and it's coupon clipper money, right? These are retail investors who are generally getting 5-6% cash on cash,
Okay.
and maybe a 9, 10, maybe 11% IRR, depending on the deal. And so uh, so but with these DSTs, generally they take like 6 months to fill out the syndication, but you have a closing time period of 60 days, 60 to 75 days that you have to close. And so the preferred equity that we would place basically would bridge so that they can close, and then they would backfill and pay off the preferred equity over the ensuing months.
Got it.
So if you have a mandatory of minimum 6 months on your preferred equity, you could take that 6 months, basically fill in the syndication, pay off that preferred equity, and then do it all over again. So I had a few capital providers that would create a bucket of money, say 15-20 million dollars for these sponsors, that they can just go and close their deals, pull money, out of their bucket, pay it off within 6 months, and do it all over again.
Wow.
And we call that it's almost like a credit facility or a preferred equity facility.
Got it. So you said you were lucky that you stumbled across this. So
I did. I was. Yeah, definitely. Sometimes you end up talking to the right people, and then you end up, knowing exactly who to call, and then all of a sudden a deal's on its way and it's working, and then, oh hey, and so thankfully I was able to kind of put together about, overall probably about 50-60 million dollars of this stuff. And of course there was a recurring kind of
wow.
fee structure. So that's what I mean by lucky. Like I was able to really settle into the real estate part of thing, without getting out there and always kind of, keeping what I kill.
So how many sponsors or owners did you serve during
Um,
these years?
on that, it was only probably 2 or 3 actually, but they had track records. They could execute. All of that was very credible,
Oh,
and of course the lender was an institutional quality. They were still a balance sheet lender, but they were institutional quality. They had some family offices who were investing significant capital. So
all right. So explain your switch now and jumping into the ownership side and the sponsorship side, and how did that
yeah.
come about?
So of course I'm always looking for something new, what I mean, but I stick with things, but then I'm also trying to always expand. And one thing that I had in my mind was I've always been worried about being a broker during a downturn, and I also saw that I was making all these these relationships on the capital provider side. Like a part of my day would be, not only would I talk to sponsors, but I would spend a good portion of the day calling up and reaching out to capital providers to keep updated on their, what the markets look like, what they're offering, their sizing, things like that. And you establish those relationships and you see the money that's out there, and it's kind of like, I want to be on the operations side. I want to be on the ownership side. That was my original intent.
Right.
Way, way, way back in the 90s. And so, being fee based as a small guy during a downturn, it's like you can get wiped out, honestly. You know what I mean? And so I did not want to do that. I wanted to have something for myself. So, I went about learning, what it takes to become, owner and get a track record and do all that.
Yeah.
Luckily, go ahead.
Yeah. Again, a lot of the listeners here are owners and brokers themselves. And, we can all relate, the market is shifting right now. And, there's a lot of brokers and realtors that are concerned, even though the houses and properties aren't having 12, 15 offers on now. They're only like 3 offers per property. Realtors and brokers still get all worked up, but it's the concept that you're talking about. It's fee based and it's just one at a time, versus the investor. They set themselves up with equity and cash, residual income, positive income. So that's what you're saying. That's the switch that happened in not the switch, but that's been your whole goal.
Yeah, I mean, listen, when you're a smaller sponsor, there is a little bit of there's competition on the acquisition side, right? You have to go out and buy properties. If you don't do a deal as a syndicator, you can't offer something to investors, and there are some fees that are able to help you keep the lights on, but you got to do deals.
Right.
And so there is a little bit of that. The one thing that I did not want to do was, and a lot of realtors do this during downturns, is they find other ways to use their licenses. And one of them, a big one, at least during the Great Recession, is people became property managers. And that's a great way of making money. That's not my jam. You know what I mean? I liken being an actual property manager to being a residential buyer side broker. Honestly, I hated it so much. Really, don't get in my car, bro. I don't want to drive you around everywhere. So, I mean, it's no knock. Everybody thrives. People thrive in all of those different things. Just not for me, and I couldn't see myself as a property manager at all. Like I like the finance stuff. So, so started on that, learning syndication, and that opened up a whole nother, then that started opening up, really kind of kicked in the entrepreneurial side, really started, helping me understand the income statement and the balance sheet, the profit and loss, statement of cash, all of that stuff really opened my eyes to what actual big businesses, normal businesses do. Right. And then you start seeing the parallels of like, okay, these are multi-million-dollar businesses, and I could take my knowledge of running this business, and perhaps overlay it on another business too.
Right.
And then you realize, okay, down deep, I'm an entrepreneur.
Right.
That's really what it comes down to. You know what I mean?
So do you have any advice for maybe a realtor or a new investor that's wanting to get into syndication? I guess how would you tell them to get started?
I think that I think there's a mindset shift from, if you're a residential side person and you're trying to move in, you're thinking about moving into the commercial. And I've been having this conversation. I have a couple of people that I coach right now, and I'm coaching on the underwriting, but invariably the program that I'm involved in, they teach syndication from the ground up. And so we have people who are making their transition from single family, buying a house here, a house there, doing flips, maybe buying a duplex, to learning how to syndicate and scale. I guess the thing that's coming out of those conversations is, realizing that a lot of us are taught on the residential side to do things by ourselves. We can
Mm,
run our
yeah.
flipping business or wholesaling. We can be out there and be a lone wolf and do it all by ourselves. And even if you partnered up, if you go beyond one person, without a VA, and you bring two or three people into your flipping business, unless you scale to a level, you can't feed all the mouths that need to be
That's right.
fed on
Right.
on that.
Yep.
And so you either have to have employees or you have to have VAs, that are very cheap labor.
Yep.
So the advice I have is really kind of getting comfortable with the idea that when you're building a bigger business, the idea is to scale, try to scale as fast, as you can to be comfortable. And you have to be comfortable with possibly working with partners. You can't do what we do by yourself. There's just too much to do.
Yeah, that's fantastic advice. The other syndicators that I look up to, you go to their website, they have teams.
Teams.
It's not just it's
Yeah.
not just maybe a partner one and a partner two. It's
Yeah.
full teams. And
Yeah.
it's a business.
And we get, listen, we get burned when we're doing single family stuff. And, you get burned and then you go, I don't want to get in that situation and I want control, and I want all
Right.
the beans.
Right.
Right. And, the Monopoly game came out in the 50s or the 40s or whenever it was. But, you know, that is one way of doing it, but it will take you forever. It will
Right.
take you forever to gather enough houses to create a multifamily empire,
Right.
and trade those all in for a hotel and so on and so forth,
Right.
and um, you
Yeah,
want to get
yesterday.
into the income quickly.
Yeah, just yesterday I had a call from one of my investors and that I've worked with before, and he's in a different market than I am, and he just says, "Hey, Jeremy, let's co-sponsor a deal together. Let's
Great.
do it.
I
We
love
got
it.
to split it up. There's no, I can't be worried about having a big chunk.
Yeah.
There was somebody that I interviewed a couple days ago, and they said they'd rather have a slice of the watermelon than a grape.
Right. Right. Like
So,
it's all relative. If you are somehow able to get into a $15 million deal, a 10 million, heck, even a $5 million deal,
right,
and
right,
there's three of you, and you're getting an asset management fee and maybe an acquisition fee to help you, feed you. But in the end, you're getting 20%, 30% of a deal
right,
that ends up selling, for double in five
right,
years.
right.
Why wouldn't you want that?
That's a
Even if
big
you have to
slice of a
split it
watermelon.
with, yeah, even if you have to, I mean, you do a few of those deals and you've built a portfolio, then you 1031.
Right.
Oh my gosh, you come into your equity and you 1031 from there. Forget it. That's where you start exponentially growing into, amazingness. So
Yeah. That's really good advice. There's a lot of realtors, a lot of brokers, a lot of single investors out there that just want to do it themselves. And that's
mhm.
fine. If they want to do it themselves and they've maybe had some generational they've inherited the business from their parents and they just want to keep it within themselves,
Yeah,
that's fine. I've just noticed that the successful ones that I'm seeing, the owners quickly divide up the work and quickly relinquish ownership percentage, give some ownership percentage to have somebody run this part of the business or this division, and they divide it up.
yeah.
That's what I'm seeing.
I mean, listen, there's a lot of real estate investors, a lot of them on the East Coast, because there's some old kind of ways of doing real estate, where one person can amass a, a, a multifamily empire, things like that. But realizing that pretty much all of the big business, from private companies that are corporations to public companies, they issue shares.
Right.
They have investors,
Right.
and so in some circles, syndication is a dirty word, right? But I think it's only because I think there's a misunderstanding about what syndicators actually do.
Right.
And so you're not only just a syndicator, you're actually in the business, you're running the business, you're
Right.
signing on the loan, you're answering the phone calls, you know what I mean? You're asset managing, you're managing the money, you're doing the accounting in most cases, like all of
Right.
that stuff.
Right.
And if you're really good and really kind of on it, there's a fiduciary kind of responsibility you have to protect your investors' capital.
Right.
And there's
Yeah.
nothing what's dirty about that. That's what every big business does or
Right.
should, you
Right.
know?
Yeah. There may be a perception that syndicators are the middleman or something, but like you
No.
just say, and the sponsors, the owners, us, we're the ones doing the entire operations.
Yeah. I mean, the capital is very important, just the same way as the debt is very important. Like everybody's needed in order to make the machine kind of run.
Exactly.
Yeah.
Excellent. So what's next for Mark? What are your plans and what are you guys
Yeah.
working on now?
So right now we're actually selling a couple of properties. So I'm on the hunt for some up leg deals. We're gonna 1031. So right now we're trying to take down some more multifamily deals. And just normally, we're looking to find deals in this marketplace. It's getting a little different. I'm actually starting up an alternative investment fund right now. It's a $25 million fund. It's what we call a customized fund, which basically it allows investors to come in, accredited investors to come in, and because we're a fund of funds, we can offer a plate from different vetted sponsors. So, say we have four deals from different sponsors, maybe a multifamily deal, a real estate debt deal, maybe a Bitcoin mining deal, and I don't know, maybe a short-term rental, right, from different sponsors. Investors can place money in the fund and then they can slice up. This is the custom part of it. They can slice up that money that they invest in the fund into those different deals. So 10 grand over here, 5,000 here,
Nice. Nice.
10 grand over here. And really, that allows them to create a custom diversified portfolio for
Interesting.
themselves.
Interesting.
So I'm really, really excited about this fund model. It's something different. Allows me to fill in the gaps where when we don't have a deal for our investors, we're able to offer something to them that's compelling, but also, allows us to work with sponsors who have track records, who are vetted, who constantly bring good deals, and expose our investors to diversification and hedging on this crazy inflationary environment we have, and
That's
still be in
fantastic.
passive investments.
That's fantastic. I
Yeah.
like that.
Yeah.
So I guess walk through. So if an investor, potential investors are listening to this, I guess can you explain, um, like when they from the time they maybe do a verbal commitment to the time that you want to see some money, or is there a required amount of deposits over a certain amount of time, or is it all at once? And then from that time, how long until those funds are actually put to use in acquiring properties?
Right. So typically I try to be 3 to 4 months out, or sorry, 3 to 4 weeks out from having to fund a particular deal. And the way this is structured is, it's a 506C, so it allows me to go out a little bit wider with some investors without having to worry about, some of
Advertising.
the SEC rules surrounding, advertising,
Right.
for lack of a better word. And generally, because we're not a blind fund, people aren't just throwing money at me, right? They want to see a deal. So
Right.
generally,
That's
I'll
kind of was
have,
my question. Yeah,
yeah,
exactly.
generally I'll have a deal.
Okay.
Even though they're going to be investing at the fund level, I'll have a deal that they can look at, and
Perfect.
then they can decide, just very broadly, they can decide if they want to invest in that deal in particular, or once they get involved in that deal, they can see some of the other things we have. And that's where the
Perfect.
customized part of it comes. So generally, they'll see a deal, maybe they'll reach out and say hi, and we'll get to know each other, or they'll just go on our portal, which we're getting set up right now. They'll go on our investor portal. They'll start working on, especially they have to be motivated. You got to be ready to invest. We have to verify your accreditation status. We have to, there's a little bit of KYC going on,
Mhm.
and you sign the fund docs. And then after you sign the fund docs, you're going to invest, and you wire over your funds. We have a minimum, and then you can decide whether you want to put everything into that one deal,
Got
or
it.
if you want to
Got
split it up and slice it up, or
it. Got it.
whatever you want to do. So
Fantastic.
that's kind of how it works. The process is it's very easy. It takes probably, I don't know, half hour, 45 minutes to get everything done.
Fantastic.
Yeah.
Fantastic. So you said in this fund of fund, what are the different asset classes that you're going to have for this one?
So right now we're about 70%, I'd say 75% going to be real estate oriented. That's my kind of core
Okay.
competencies, right? Just because of the finance stuff and just my operational expertise. And so I'll be offering, syndicated real estate throughout, pretty much all asset classes, commercial wise. So industrial, maybe there'll be some, mixed use properties, multifamily, definitely.
And then what
Um,
locations or what markets for this?
um, I'll be concentrating on markets that I personally like. So I love the Midwest. I love, Kansas, Missouri. I love Ohio, Columbus, some Cincy. Um, Indiana, Indianapolis is a great market. And I also like the smile states in the Southwest. So we stay away from California for multifamily. But if there are, industrial or industrial flex deals in California, we love that type of stuff. Arizona, Nevada, Texas, all the way through,
Got
all
it.
the way over to North Carolina. Smile,
So that
smile,
fund of fund
Montana.
the fund of fund model really gets you to diversify across a lot of good markets.
100%. Especially when it's coupled with, there are fund of funds that don't necessarily have this custom, angle, which is something very special and something very new. Most of the time, when you have a fund of funds, it's really there's only one deal, and when you come in, you're really just investing in
Right.
you're putting your 50,000 into that one deal, or
Right.
there's another deal, and you can't slice up your fund level money into all these different smaller amounts. Yeah. So say your fund of fund manager has two deals and they have a minimum of 50,000, generally you're going to have to put 50 in each of those. So it's $100,000 ticket,
Right.
right?
Right.
Yeah.
I like that.
And
That offers the investor huge opportunity to diversify.
100% and choice,
Yeah.
right? A lot of times when you're dealing with funds, the choice is kind of taken away from you in one way or another,
Right.
right? Either you're asked to invest blindly in what we call a blind pool, right? Where they don't have they give you a sample. This is what we're going to be looking for. Give us your money. We'll ask you down the line, for more money, maybe, based on your total commitment when we find deals. Or they found deals and you don't really have a choice on whether or not, to invest in it. Um, or it's a fund of funds where it's just a straight shot into one or
Right.
two deals, but at a higher investment amount.
Right. Yeah, I guess that was my original that other question that I had was I was assuming that it was a blind fund of funds. So thank you
Yeah.
for clarifying that.
Now, generally they'll be seeing deals.
Yeah.
So right now I have I'm getting ready to bring on a preferred equity fund, um, which will basically preferred equity. It's more like we call it dequity, so it's a hard coupon payment, but it sits right in the middle on the capital stack. So it's not like it's right between the actual equity and the senior loan. And but it's almost like imagine it being like a second loan or second position loan for commercial,
Right.
right? And higher coupon, but you don't participate in the upside, but you do get some of the depreciation.
Right.
And so typically, and so and it's a velocity money, so you could be out, you could be getting 10% a year, 12% a year, and be out in 2 years or 3 years, and then you can do it all over again in the same fund.
So how
So
can retail investors, I guess, nor be involved get how can normal investor get involved on that side?
in terms of
Or
what?
or is that just a large companies that do that? The preferred equity
You mean in terms of investing directly in the fund?
in that
Um,
second position. The preferred equity second position.
Generally, so if you have a retail investor who has $50,000 to invest,
It'd be better
um,
to invest in as a
yeah, they're
prime
not
position.
usually seeing, they're not usually see, there's a couple of things. They're not usually seeing the really good, you know, like say you have 50,000, or even our minimums are 25,000. So say you have 25,000, the actual fund has $100,000 minimum. So you're not going to be able to access it anyway.
Got it.
Like
Understood. Yep.
yeah, you're too small. So there's that. And with, if you invest through our fund, we're taking on a slice of about $1 million in order to get premium pricing because we're pooling within our fund. And so it allows you to get in, get the premium pricing and get in on a deal that you're not able to access generally.
Right. Right.
You know?
That's a good point.
Yeah.
Yeah. Thank you for explaining that. Excellent. So what else?
Yeah.
What
So
else
yeah,
is on your
I
sites?
got a, you know, I got a podcast like you, 10X for Gen XYZ. We're kind of out there doing some of the same stuff that you're doing, which is great, and trying to get the word out, not only with real estate, but you know, we're also a focus with mindset and, you know, health, wealth, and business. Um yeah, that's about it. You know, just keep on moving on.
Excellent. Well, thank you so much for coming on the show. And so I guess we'll finish with, I guess, where can the listeners find you?
Yeah, absolutely. So I think the first thing is to go to birchstonewealthfund.com if you want to know about this fund of funds model. Love to, you know,
Say that again.
it's called birchstonewealthfund.com, all one word. And from there, I should have my deals kind of loaded up starting. I got one deal up there right now, and then I should have a couple deals loaded up starting middle of next week or so.
Excellent.
And you can always find me on LinkedIn. Just look up Mark Rios CRE or on Facebook and reach out to me. You know, hook up with me. I'd love to hear what's going on with you, and you know, love talking real estate for sure.
Excellent. Well, thank you so much, Mark. And that's a wrap for this episode of Wealth Building Strategies Podcast.
Great. Thanks for having me.